You can scroll listings today and nothing looks broken. Homes still photograph beautifully, prices haven't collapsed, and there's no panic in the air. Open houses happen. Agents smile. On the surface, the market feels calm, almost boring. And that's exactly why this moment matters, because beneath that calm surface, something essential is quietly slipping away. Most people are trained to watch price. Red numbers mean danger, flat numbers mean safety. But professionals watch movement. They watch how fast homes sell, how easily deals close, how often buyers hesitate, and how many listings quietly return to the market. Those signals don't scream, they whisper. And right now, they're whispering the same thing across many markets. Liquidity is thinning. Liquidity is the ability to move, to sell without begging, to refinance without friction, to exit without damage. When liquidity is strong, price can stretch and mistakes get absorbed. When liquidity weakens, price hasn't fallen yet, but options already have. Homes take longer to sell. Deals die later instead of earlier. Buyers qualify but pause. Sellers wait, assuming time is neutral, not realizing time is already charging interest. That's why this phase is so dangerous. Nothing looks wrong. There are no headlines warning you to pay attention. The market hasn't announced a downturn. It simply stopped moving the way it used to. And that slowdown is easy to dismiss if you're only watching prices. But movement tells you what price hasn't admitted yet. If you've been paying attention, you've felt this shift before it had a name. Showings without offers. Reductions framed as strategy. Buyers taking a second look instead of rushing. Sellers feeling resistance they can't quite explain. That confusion isn't random. It's the early signal of a market losing flexibility. This isn't alarmism. It's orientation. Liquidity always leaves first, quietly, politely, without drama. Price follows later, when options are already gone. Seeing that sequence early doesn't make you fearful. It makes you prepared. That awareness separates observers from participants long before consequences arrive and choices quietly disappear entirely now. Subscribe and hit the bell. Liquidity disappears quietly before prices do. Liquidity is one of those words everyone hears but almost no one truly understands. It doesn't mean demand, and it doesn't mean price. Liquidity is simply the ability to move. To sell a home without discounting aggressively. To refinance without friction. To exit a position without panic or damage. When liquidity is healthy, choices feel abundant. When it fades, choices shrink quietly, long before prices ever admit there's a problem. This is why most people miss it. Liquidity loss doesn't announce itself. There's no headline that says, "Exits are getting harder." Price charts stay flat. Listings still look attractive. But underneath, the process slows. Homes sit longer. Buyers hesitate. Escrows stretch. Deals fall apart after inspections instead of before offers. Nothing dramatic happens, yet everything becomes heavier. Think of liquidity like oxygen. You don't notice it when it's there. You only notice it when it starts disappearing. Markets work the same way. As long as transactions move easily, people assume health. The moment movement slows, stress builds, even if prices haven't moved an inch. Days on market are the first clue. A home that takes twice as long to sell hasn't lost value yet, but it has lost flexibility. That extra time invites questions. Why hasn't it moved? What am I missing? Buyers don't articulate this consciously, but they feel it instantly. Time changes perception, and perception shapes leverage. Failed escrows are another signal. When contracts get signed and then quietly dissolve, liquidity is already weakening. The excitement phase still exists, but verification kills confidence. Inspections feel heavier. Appraisals interrupt optimism. Financing takes longer and asks harder questions. These aren't isolated inconveniences. They're symptoms of a market that no longer absorbs risk easily. Buyer hesitation ties it together. Buyers still qualify. They still tour. They just don't rush. They revisit numbers. They sleep on decisions. They compare alternatives. Waiting doesn't feel dangerous anymore, so they use it. That patience is not fear. its adaptation to thinning liquidity. Here's the critical reframe. Liquidity is not demand. Demand can exist while liquidity evaporates. People can want homes and still struggle to transact cleanly. When liquidity weakens, outcomes depend less on desire and more on alignment. Terms matter. Timing matters. Flexibility becomes currency. Understanding this removes anxiety. Nothing mysterious is happening. Markets aren't broken, they're tightening. Liquidity leaves quietly, first through time, then through terms, and only later, through price. If this reframes how you see the market, hit the bell. Liquidity doesn't collapse with noise. It fades while everything still looks active. Homes continue to get showings. Open houses aren't empty. Conversations start easily. And yet offers don't materialize. This is the first sign most sellers misinterpret because attention feels like demand. It isn't. Attention without commitment is friction, and friction is how liquidity begins to fail. The next signal shows up later in the process. Deals don't die at the offer anymore. They die after inspections, after appraisals, after underwriting starts asking harder questions. On paper, the buyer qualified. Emotionally, the buyer was interested. Practically, the math didn't clear with the same ease it used to. Each late failure quietly trains the next buyer to hesitate longer. This is where social proof reverses. A listing that once felt validated by activity now feels questioned by time. Buyers notice how long it's been available. They assume someone else already looked closely. Silence becomes information. Even well-priced homes start to feel negotiable, not because something is wrong, but because time implies optionality. Sellers feel confused here. Nothing obvious is broken. The home shows well. Feedback sounds positive. Agents say the market is still active. So sellers wait, believing patience protects value. But time isn't neutral anymore. Every extra week adds an invisible cost. The longer a home sits, the more leverage shifts to the calmest buyer. Quiet price reductions follow, not urgent drops. Small adjustments framed as strategy. Sellers don't feel desperate, but buyers feel validated. Each reduction confirms waiting works. Buyers who might have stretched before now pause, expecting further movement. Liquidity thins without price collapsing. Time on market becomes the silent tax sellers never budget for. It doesn't show up as a line item, but it compounds daily. Every additional showing without an offer lowers perceived certainty. Every unanswered follow-up shifts negotiation power. Sellers sense this as vague resistance, not rejection, which makes it harder to respond decisively. Buyers, meanwhile, feel increasingly comfortable. They bookmark listings. They revisit them weeks later. They wait for terms to improve instead of pushing price. That comfort is expensive for sellers, because once buyers feel safe waiting, urgency cannot be reclaimed. Liquidity doesn't vanish overnight. It bleeds out through time, quietly transferring control to whoever is least pressured to act. By the time sellers recognize this cost, options have narrowed, leverage has shifted, and decisions feel forced rather than chosen under pressure with fewer paths available remaining. Loss aversion makes this stage dangerous. Sellers fear reducing too much too soon, but underestimate the cost of reducing later. Selling for less after waiting feels worse than adjusting early, yet waiting feels safer emotionally. That mismatch is where leverage is lost. This phase escalates quietly. More listings sit. More escrows fail late. More buyers qualify but delay. None of it feels dramatic, which is why most people misread it. By the time sellers feel urgency, time has already done its damage. Stay with us. This is where most people misread the market. Price always moves last in housing markets. That truth feels counterintuitive because price is the only thing people watch. Listings sit, deals fail, momentum fades, yet sellers keep pointing to comps. They believe price defines reality when belief actually does. That belief is why prices haven't fallen yet. Sellers anchor to the past because the past feels safe. Anchoring bias makes yesterday's sale feel more real than today's hesitation. A strong comp becomes emotional armor against uncomfortable signals. As long as price hasn't changed, sellers tell themselves nothing has changed. That story delays adjustment while liquidity drains underneath. Liquidity collapse feels abstract, so sellers ignore it. Fewer offers don't feel like danger if showings still happen. Failed escrows feel unlucky, not structural. Longer days on market feel temporary. Each signal gets rationalized away. This is why price lags reality. Price is a public admission that belief broke. Lowering price feels like announcing weakness. Sellers delay that admission as long as possible. Meanwhile, leverage is quietly moving away from them. Buyers feel this shift before sellers accept it. They sense flexibility, not desperation. They negotiate terms instead of chasing numbers. Waiting becomes safe, even profitable. Everyday price holds while liquidity fades, increases buyer power. The danger is timing. By the time prices visibly fall, choices have already narrowed. Sellers who waited feel forced instead of strategic. Buyers sense urgency and push harder. What felt like patience becomes regret. This is why falling prices aren't the beginning, they're the confirmation. Liquidity left earlier, silently. Price just makes it undeniable. If you're waiting for price to act, you're already late. Understanding this restores control. It shifts focus from headlines to movement. Professionals adjust before numbers force them. Everyone else waits for confirmation. Subscribe. Price moves last, leverage moves first. That distinction determines outcomes. Markets punish delay far more than adjustment. Early realism preserves options. Late realism narrows them. Nothing about this requires panic. It requires attention. Liquidity is the signal that tells you where power is moving. Ignoring it because price looks stable is how sellers lose leverage quietly. By the time prices respond, the market has already chosen sides. That's the risk hidden inside calm surfaces. Everything feels negotiable until suddenly it isn't. Those watching liquidity see the turn early. Those watching price react late. The difference decides who adjusts by choice and who adjusts under pressure. That's why this phase is dangerous. It looks stable while leverage quietly disappears. Recognizing that now changes outcomes later. Waiting for price to prove it only limits options. Markets reward those who move with information, not emotion. Seeing liquidity first is how you stay ahead. That awareness is the edge most people miss. When liquidity breaks, it doesn't break everywhere at once. It breaks where buyers have the most choice, the least obligation, and the strongest reasons to pause. Certain markets always feel this first, not because they are weak, but because they are sensitive. Investor-heavy metros sit at the top of that list. These markets rely on capital that expects flexibility. Investors don't buy because they need shelter. They buy because numbers work. When yields compress or appreciation slows, they don't panic. They simply stop. That pause removes an invisible layer of demand that once absorbed listings quietly. Homes still show well, prices still look firm, but the backstop disappears and liquidity thins almost overnight. Tech-dependent income hubs behave similarly, though the mechanism is different. Tech wealth is powerful but volatile. Compensation often depends on bonuses, stock, and confidence. When hiring slows or equity fluctuates, buyers don't rush to lock themselves into long-term commitments. They wait. They reassess. They protect optionality. Even highly qualified buyers hesitate when future income feels uncertain. That hesitation alone is enough to slow transactions without creating fear. High-price-to-income markets are next. These areas function on belief more than buffer. Buyers stretch because they assume growth will rescue today's sacrifice. When that belief weakens, even slightly, stretching stops. The pool of buyers who can act shrinks quickly, not because demand vanished, but because tolerance did. Liquidity fades faster, here because there is no margin for hesitation. Every delay matters. Overbuilt migration zones complete the picture. These markets expanded rapidly on narratives of inbound demand and lifestyle shifts. Builders responded aggressively. Supply crept up just as buyer urgency softened. When migration slows or stabilizes, excess inventory doesn't crash prices immediately. It creates choice. Choice changes behavior. Buyers stop competing. Sellers start waiting. Liquidity breaks quietly. What ties these markets together isn't emotion, it's structure. Optional buyers dominate. Capital is sensitive. Stories matter more than fundamentals. When stories wobble, liquidity leaves first. Prices only respond later, after enough time passes to force recognition. This is why watching price alone misleads people. These markets don't flash warning signs. They feel normal until they don't. Showings continue. Listings look strong. But deals fail later. Negotiations stretch, and exits become harder. Understanding this creates foresight, not fear. These patterns repeat before every downturn because they're built into how modern housing works. Liquidity breaks where flexibility exists. It holds longest where necessity dominates. That distinction matters because liquidity loss doesn't announce itself to owners living inside it. It shows up as longer conversations, softer commitments, and buyers who always seem interested but never decisive. Sellers feel busy, not vulnerable, until months pass and options narrow. By then, the market has already chosen. Liquidity isn't moral, fair, or emotional. It's mechanical. When it fades, outcomes compress. Recognizing where it fades first allows you to step back, adjust expectations, and avoid being forced into decisions later under pressure. If you live, invest, or plan to act in any of these markets, awareness is your advantage. You don't need to predict collapse. You need to recognize where movement slows first. Hit the bell. These patterns repeat before every downturn. Seeing them early doesn't mean acting rashly. It means thinking clearly while others are still comforted by appearances. That clarity creates space. Space to wait, negotiate, or simply observe without anxiety. In markets driven by belief, those who understand liquidity early regain choice, while others surrender it unknowingly. This isn't about timing the bottom. It's about staying solvent in options, not just price, as cycles turn quietly. That awareness separates prepared participants from reactive observers today. When liquidity disappears, most people assume everyone loses. That assumption is comforting because it removes responsibility. But thin liquidity doesn't reward panic or aggression. It rewards preparation. It shifts leverage quietly toward people who understand timing, documentation, and realism better than anyone else in the room. Prepared buyers benefit first. They aren't chasing inventory anymore. They're evaluating it. Liquidity loss slows the market enough for buyers to ask better questions, model outcomes, and walk away without consequence. Instead of stretching to win, they protect flexibility. They negotiate terms, not just price. Inspections matter again. Appraisals matter again. Waiting becomes a tool, not a risk. Flexible sellers can win too, though fewer recognize it early. These sellers stop anchoring to peak narratives and start responding to present behavior. They price for momentum, not memory. They adjust cleanly instead of defensively. Buyers trust clarity in uncertain markets, and trust restores movement faster than stubbornness ever does. Liquidity doesn't disappear for everyone at once. It disappears last for those willing to adapt. Patient operators sit in the middle. Investors, relocators, and long-term planners understand that liquidity cycles are opportunities to regain control. They don't rush to deploy capital or retreat entirely. They wait for alignment. When liquidity thins, data accumulates. Patterns become visible. Mispricing reveals itself. Operators act when risk is measurable, not when noise is loud. What's really happening in thin markets is a redistribution of power. Speed stops being impressive. Boldness stops being rewarded. Documentation, transparency, and timing take over. Leverage moves away from storytelling and toward proof. That shift feels uncomfortable only if you're still trying to play a momentum game that already ended. This is where fear quietly exits the system. Once you understand liquidity, waiting stops feeling passive and starts feeling strategic. You no longer need prices to fall to gain advantage. You gain it by preserving options while others surrender them through impatience. The winners in this phase aren't smarter or luckier. They're calmer. They accept slower markets without interpreting them as failure. They recognize that liquidity loss punishes those who need immediate outcomes and rewards, those who can choose their moments deliberately. If you're prepared, flexible, or patient, this isn't a threat. It's a shift in rules. Clarity replaces urgency. Alignment replaces competition. Control returns to those willing to slow down and observe before acting. Subscribe. Clarity is the new leverage in uncertain markets today. Every cycle ends the same way, even though it never feels that way while you're inside it. Markets don't break when prices finally move. They break earlier, when liquidity quietly leaves and no one notices because everything still looks fine. Homes photograph well, prices hold, confidence lingers. But the ability to exit, refinance, or negotiate on fair terms slowly disappears, and by the time price reacts, leverage is already gone. That's the pattern worth remembering. Liquidity leaves first, every time. Not loudly, not dramatically. It slips away through longer timelines, failed escrows, cautious buyers, and sellers who wait a little too long for yesterday's certainty to return. When people finally agree prices are falling, the decision space has already narrowed. This is where awareness matters. Watch your local market, not the headlines. Pay attention to how long homes sit, how often deals stall, how buyers speak when they think no one is listening. If you're seeing hesitation replace urgency, you're not early or late, you're on time. Share what you're noticing where you live. Patterns become clearer when people compare notes instead of reacting alone. In the next video, we explain how time forces price without panic. Stay subscribed now.